In this video, we're going to be chatting about all the different ways in which you can diversify your financial portfolio. We'll touch on concepts like mutual funds, index funds, real estate, stocks, commodities, and more. Let's get started in trying to diversify your knowledge.
Hey everyone, so today we're going to talk about diversification. So a lot of you watch me and talk about crypto a lot and not talk about gold, not talk about silver, not talk about stocks that often, not talk about bonds, ETFs, etc. So what I'm going to tell you today is how I've diversified and how you probably could diversify as well. Now, I'm not telling you every single way I've diversified, but this is the things that I've looked at to diversify, okay? So it's something that you should take in consideration. You shouldn't put all your eggs, as you see, in one basket, okay? So let's get started on what you can do to diversify yourself and what things you can have so that you are diversified in case one market, doesn't do as well. So, for example, cryptocurrency 2018 did not do so well. But if you were in stocks and other things, you probably would have actually had a positive year. So that is what you have to think about here. When we look at diversity, we see that there's a lot of different things that we can look at, right? So the first thing we can look at here is cash. So obviously, cash rules everything around you. You should always have some liquidity in terms of cash money until we don't use cash anymore. I've said many times hyperinflation is coming, and it has. You've seen this in Turkey. You've seen this in Venezuela. You've seen this in Argentina. So we're seeing in many different countries this hyperinflation of currency, okay, which makes dollars worth less money. But the thing is, you still need cash right now to buy things. So you need to have some liquidity in cash just in case you need money right away for whatever reason, emergencies, etc. Moving on, a really, really good asset to have is a house, real estate, condo, land. Why? Because land, even if we have a recession, even if we have a really bad year in a market, land is always going to have a value because people need somewhere to live and stay. So real estate is always what a lot of people do is hold land in real estate so that they have something that is a good asset to hold. That's a very big liability to have a house and stuff like that, but it's equity, and it's good to keep a store of equity in land because God forbid anything happens in a market, at least you have a house. And you can live somewhere. So that's really a good point to bring up. So another way to save money is put it away in a retirement savings fund, a 401k, etc. And what these things do is they invest money for you in a low interest way, but over time, obviously, it compounds with everyone's money together. They take low risk, and you then have money to live your life afterwards. Governments do this for people. You have pension funds do this, etc. So there's many ways you can save for your future, and this is good for later on in life. The next thing is stocks. So obviously, stock market, if you've been in it since 2009, it's been growing and growing. If you've been in for the last little while, you're probably very happy. But what we know about stocks is they go up and they come down. So the thing is about stocks that when they come down, you can short them, and when they go up, you can buy them long. So if you don't know how to trade, that's okay. But people buy things like Apple and Microsoft and things like that because they're very steady companies, and usually they do not lose a lot of their value over time. Even if it goes down, usually whatever goes down will come back up. So stocks, if you have good picks, etc., and someone to manage that for you. I'm not a financial advisor. I'm not going to tell you what to buy or not buy, or to even tell you to buy stocks, but you can do this with a financial advisor, and they can kind of give you the guidance you need for what stocks you should buy. And obviously, if you do your own research, you will then know which companies you support and think will do well long term. So that's basically how stocks work. You own a piece of the company. So next thing is mutual funds. So this is basically taking a bunch of your money, putting it all together, and basically you give it to a fund manager. So everyone puts their money together, gives it to this guy who is very good at trading. He'll invest in securities or stocks, okay? And those securities, obviously, you're buying them with the idea that they're going to increase in value. So when they increase in value, they generate money for you in return, and then you get your money back. So that's basically how mutual funds work. It's basically like giving someone your money to make you money because you don't know how to trade yourself. So the next thing are bonds. So bonds are basically there's government bonds and different things like that. But basically how a bond works is you're loaning money to a certain person, organization, government, etc. And you're getting a guaranteed return. So for example, I will give you $10,000, and when 10 years goes by, or 5 years, or a year goes by, you're going to give me a guarantee of 4.5% interest. And I'm going to get that for sure. So that's how bonds work. You lock them up for a certain amount of time and you get interest back. Next thing we look at is index funds. So index funds work like this. I see the S&P 500, the whole entire stock market of them, the whole entire NASDAQ, the whole entire Dow Jones. And what I'm going to do is invest in those. Okay, so what I'm going to do is put my money into these funds. Okay, and what I'm going to do is, as the whole entire stock market grows, I will get percentages each year to equal that. So if I invested in 2009, I would be getting a very nice 121% return by now from the Dow Jones. So you can invest in the actual market. And what the good thing about indexes are similar to bonds, they give you a guaranteed rate of return. But not only is it a guaranteed rate of return, it's a little bit better because if it outperforms that rate of return, so if the market goes up 10% in a year, you will get 10%, not 4.25, for example. So that's the benefit of indexes. A lot of people have some in their portfolios, and it's because they guarantee profit. So it's a very low risk investment, low return, but could have potential high returns. 121% is not bad either. So we can think about it that way too. Okay, guys, so what is a commodity? A commodity is things like water, oil, gold, silver, corn, minerals, coffee, water. These are all commodities, okay? Another commodity as of October 5th, 2018 is Bitcoin. What does that mean? Well, you might have heard about ETFs for Bitcoin. Now, you're probably asking the question, what is an ETF? So let me tell you, the definition of an ETF is an exchange-traded fund. So what is an exchange-traded fund? It's a security that tracks a whole entire index, a whole entire commodity, a whole entire bond or asset bank, okay, like an index fund. Unlike mutual funds, though, ETF trades like a common stock, so on the stock exchange. So ETFs experience price changes up and down, and the good thing is they have high liquidity and low fees, so that's better than a mutual fund. So that's why people like them, okay? So an ETF, if you have underlying assets like these ones behind me, like an industry underlying asset, like all of the high-tech industry, that can be your underlying asset. You can have an actively managed fund, so someone is controlling that and going in and out of ETFs for you. You can have index ETFs, commodity ETFs, inverse ETFs, so thinking that the shorting is going to happen. So we have all these types of ETFs as well as foreign markets. These are all the ways that you can diversify your portfolio, and you don't need to have all of them, but you shouldn't have all your eggs in one basket. All right, guys, see you on the next one. This is how to diversify your portfolio.
Fat kiddo, fat kiddo, fat kiddo, huge fat kiddo.